Hello. Yeah, hi. Welcome to another video in CMA Part 1, Section D. This will be dealing with cost allocation when you have joint products and byproducts. Okay, so joint products and byproducts. So first we will see what is joint products. You can see here a diagram in which you have crude oil refining process happening here, and you have a cost of 10 million for this. Okay, so you made crude oil and you spent 10 million, and from this crude oil you are making three products: petrol, diesel and kerosene. So three products you are making out of this crude oil. Okay, now the question is, how much this petrol will cost us? What's the total cost of petrol? And how much for diesel and how much for kerosene? This we don't have the details here, right? Because here it was going through a joint process and we spent 10 million altogether. And out of that 10 million, we made petrol, diesel and kerosene. Okay, now to set the price of petrol, we need to know how much we spent on this, right? What was our cost? So this 10 million, whatever we spent jointly for making crude oil, that need to be allocated to petrol, diesel and kerosene. So this is what we are going to discuss in this presentation actually. And here you can see different things we have seen here. This is what our joint process is, and for this process you have a cost that we call it as joint cost. And from this point you can see you are splitting the crude oil into three, or we can say this is the split off point. Okay, so cost incurred before split off point is what we call it as joint cost, because that cost is incurred for joint process. Now once it is splitted into three, or you are going to make petrol, you will be going through certain process here also, right? Crude oil need to be converted to petrol. So this process we call it as further process, and whatever dollar amount we spend here, that we call it as further processing cost. So total cost of petrol is equal to what? Further processing plus further processing cost plus a portion of joint cost. Same like diesel, it is having its own cost and allocation of joint cost. Okay, so this is the scenario. Here we have to understand few terminologies. That is what we are discussing here. Joint products, we know that two or more products that are produced sharing same production process up to a point called split off point. And joint costs are the cost of a single production process that yields multiple products. So the cost what you incurred, this is what actually joint cost is, because this joint cost is going to yield multiple products. And the joint costs are incurred prior to the split off point, need to be allocated between two or the joint products. So whatever cost incurred before split off point, that is what joint cost is, and that need to be allocated to multiple products. And the cost incurred after the split off point, we call it as further processing cost, that is individually incurred for each product. So total cost of petrol, for example, it is going to be cost of petrol and some cost from the joint cost. So two cost you have to add to get the total cost of petrol. So split off point, we know that you can just read the definition. And separable cost is also, we know this is the cost you incurred after the split off point. And split off point is the juncture in the production process where one or more production process in a joint cost setting became separately identifiable. Okay, and we have a concept of main product and byproduct. We will be studying how to do accounting for byproducts and all by end of this presentation. So main product, as we know, is the result of a joint production process that yields only one product with a high sales value. And byproducts are incidental products resulting from processing of another product. So what is byproduct and main product? You can say you have a lumber mill, or we can say a wood mill is there, where you are cutting woods and shaping woods and selling it off. And while doing this process, you are getting some sawdust. Okay, the sawdust, the waste of this wood that can be used by some other wood products manufacturers, and that is sellable also. But here the value of the main product is high. Correct? Value of main product is high and this is low. So that is how we will segregate main product and byproduct. So as the value of the low product is increasing, for example, then we have to consider main product as the old byproduct, and this will be considered as a byproduct. Again, it is based on the value of the product. That's what it is mentioned here. Products can change from byproducts to joint products with their relative sales value increases. So byproduct sales value is increasing. Maybe it can be change from byproducts to main product, and main products, if its value is decreasing, so the main product can be converted or can be changed to byproduct. So that is what this explained here. Main products or joint products are high in value, byproducts are low in sales value. So now we will be doing the allocation of joint cost. Okay, we'll be doing now allocation of the joint cost. So while doing this allocation of joint cost, we have to consider like different approaches. The first approach is physical approach. So we will allocate the total cost, total joint cost, based on how many units of each products produced, or what is the weight of each products produced. So basically, you will allocate the total cost based on how many units of each joint products produced, or we can say some type of volume or weight, something we will consider. Approach 2, this is based on the revenues or based on market-based data. So we have here three methods: sales value at split off, estimated net realizable value, and constant gross margin percentage. So we have to see all of these methods. Okay, so let's go and look at each and every methods. Here you can see the first method is physical measure method, or it is also called as average cost method. So as I mentioned earlier, what we are doing here is we are taking the total cost, total joint cost, and splitting the joint cost based on how many units of each products produced. So it is based on a physical measure of each product's output. So measures you can use weight, volume, units, whatever. So here we have an example. Okay, a dairy farm produces both milk and cheese. Okay, so dairy farm is producing both milk and cheese, so they have some cost, right? That cost and all, it is incurred jointly. For example, feeding the cows, labor cost is there, facility maintenance, all this cost we call it as joint cost in this case. And this cost need to be allocated between milk and cheese. So if milk accounts for 80% of the total volume, So milk is, or the volume of milk is like 80% out of the total production, then 80% of this joint cost will be allocated to milk. So in short, it is based on how much output you have for each products, you will allocate the total cost. Here we have the example, a refinery incurred total $10,000 in joint cost and they produced petrol and diesel. So joint cost here is 10,000 and they have two products, petrol and diesel, and the number of gallons of petrol is 5,000 and gallons of diesel is 3,000, and for this they spend $10,000. These are just hypothetical numbers. I made it easy for you to understand. It has nothing to do with the market value. Okay, so using the physical measure method, calculate allocation ratio and allocate the joint cost to petrol and diesel based on their respective quantity. So it is very easy. You have $10,000, which is the total total cost, and that need to be allocated between petrol and diesel based on how many units we produced or how many gallons we produced. The next slide we will see that how we will do. We can see here total cost is 10,000 and petrol 5,000, diesel 3,000, and total 8,000 units we produced. So we have to find out an allocation ratio, on what basis we will allocate this 10,000. So in this case we are doing physical measure, right? So we will take 5,000 of petrol out of total 8,000, right? So 5,000 divided by 8,000. So petrol is coming to 62.5% of the volume when compared to the total volume. And diesel is 3,000 out of 8,000, you can see, and that is coming to 37.5%. So 62.5% is the allocation ratio for petrol. So here, sorry, I have some difference. This is petrol and this is diesel. Okay, some example I changed later. Okay, so now $10,000. So this is petrol and this is diesel. So $10,000 multiplied by 62.5%, 6,250 out of this 10,000 will go to petrol, and 10,000 multiplied with 37.5% or 3,750 will go to diesel. It is based on a percentage of the output what we have. Okay, so this is what actually physical method, very easy to do the calculation. Okay, so benefits of this is easy to use and allocation is objective. You are allocating based on what we actually produced, and especially when you are in a regulated environment. For example, what is a regulated environment? Government is telling you you can add 20% margin on whatever your cost is. Okay, in such cases you can use this method, because here seller doesn't know what is the selling price is. You can take the total cost, add a percentage on that. So in that case you can use this method. Limitation: physical measure are not always comparable. For example, out of this petroleum or out of this crude oil refining process, you can have multiple products. Some products are in liquid form, we can say petroleum. Some products are in gas form, say natural gas. So how you will compare? If all the products are in liquid form, we can say these are based on gallons. So 1 million gallon petrol, 500,000 gallon diesel. So you can do the allocation. But when it is in gas form, how you are going to allocate it? It is not easy to compare. When you have products that is not in same quantity or same measurement, we can say. And also physical measure and average cost method can result a product cost that is greater than their market value for some of the joint products. So this is another issue with physical method, here we are allocating the total cost based on what we produced. So which one is produced more, that will get more of the cost. So imagine you have two products. Okay, we have an example here. We have two products, product A and product B. Product A you are making 7,000, product B you are making 3,000. So obviously you can see from here, product A will get more of the joint cost, right? More of the joint cost A will get, and less of the joint cost will be captured by B. And we can just check what's the selling price of A and B. A is sold for 0.8 and B is sold for 3. So if I sell, we can say 7,000 units of A at 0.8 per unit, our revenue is going to be 5,600. 7,000 multiplied with this 0.8. And for product B, it is going to be 3,000 multiplied with $3. So it is going to be 9,000. This is the revenue. And now we will see how the allocation is going. This 10,000 we need to allocate between two products, and A is 7,000, B is 3,000. So 7,000 out of this 10,000, that's what here, 7,000 out of 10,000 multiplied with 10,000, you will get $7,000. So your cost now is $7,000 because A produced more in our scenario, but the revenue what you are getting is only 5,600. So sometimes you may get allocation of cost to product which is more than the market value of that product. I hope you understood this. Now we will go to the second method, which is sales value at split off point method. So we said in the beginning, the first method is based on physical number of units you produced. Now from here onwards, we are looking at what is the sales value of the product. Okay, so here the first method is sales value at split off point. So imagine you are going through some process and you can sell the products immediately after the joint processing. So you can sell both the product in the split off point itself. And what is the sales value of this product at split off point? It is based on that you will allocate the cost. So it is based on the market value. It has nothing to do with the volume. So what is the market value of two products? You will find out a proportion of the market value of each product, and based on that proportion you will allocate the total cost under sales value at split off method. But here we have to remember that all the output must have sales values at this point. So you are doing some process and you have two products. This product you can sell as it is, but this product you cannot sell as it is because this need to be worked on. You have to do some process which is we call it as further process, then only you can sell it. So this product B doesn't have a selling price at split off point. This have a selling price at split off point. In this case we cannot use sales value at split off because all the products is not having sales value at split off point. So we can see an example of sales value at split off method. Here a farm produces two types of vegetables, which is carrots and beets, from same crop. You see, I think this is the example came there in case of petrol and diesel. I'm sorry for that. And these vegetables are harvested and separated at the split off point. Okay, so you are harvesting this vegetable and you will be separating this at a split off point. At this point, farm has incurred common cost for planting, cultivating, harvesting the crop. You incurred some cost, right? Now this cost need to be split between carrots and beets. So whatever cost you spend on, cultivating these products. And these are the cost what you incurred. So joint cost, which is for planting, cultivating and harvesting and all, it is $10,000. And at split off point, you have two products, 5,000 pounds of carrots and 3,000 pounds of beets. Okay, and at split off point, the market price of carrot is $1 and market price of beet is $0.8. Okay, so now how we are going to calculate? Again, it is easy. This is the total cost. This is what we have to allocate between carrots and beets. And here we have 5,000 lbs of carrots produced and 3,000 lbs of beets produced. Okay, and market price of carrot is $2 per lb, and here it is $1.50 for beets. So you can see 5,000 multiplied 2, it is 10,000. 3,000 multiplied with 1.5, it is 4,500. So total sales value is 14,500. Now you have to allocate the cost based on this amount. So out of 14,500, carrots value is 10,000 and beets value is 4,500. So first we will allocate, or we will find out allocation ratio for carrots. That is going to be 10,000 divided by 14,500, which is 68.96. So 68.96 multiplied with this 10,000, here you can see you will get 6,896 will go to carrots, and for beets the ratio is 31.03. So 31.03% of the total cost of 10,000 will go to beets. Okay, so your allocation is 6,896 and 3,103 based on market value at split off point. So we can calculate our profit in this case. Carrot sales value at split off is 10,000. Here it is 4,500. Allocated cost we can see, and this is what the gross margin is, right? And you can see the gross margin out of this 10,000 is 31%, and 1,396 out of 4,500, that's also 31%. So this is what one of the peculiarity of this method. Sales value at split off method produces identical gross margin percentage for each product, because we are allocating the total cost based on the sales value at split off point. Okay, so here the gross percentage, so the percentage of gross margin is going to be same. So this is the second method, which is sales value at split off method. Again, not difficult. You have to find out what is the sales value at split off point for each product. Okay, then add that together. Then take the sales value of individual product, divide that by the total, whatever you calculated, you will get a percentage of allocation. Then you will multiply this percentage with the joint cost, and you can calculate the amount need to be absorbed by each product. So benefits of this is costs are allocated to products in proportion to their revenues, which is in proportion to individual products' ability to absorb the cost. So here cost is going to be allocated based on the revenue percentage. So it is based on how much they can absorb, their ability to absorb this cost. So high revenue products will get high cost, and products which is yielding low revenue will take only low cost. Okay, so that is one of the benefit. Again, this is easy to calculate, and it can be used even if further processing is to be done, as long as selling prices do exist for all the joint products. So even you are doing further processing, but if you know the selling price at split off point for all the products, you can use this method. These are the benefits. The limitation is, to use this method, selling price at split off point for all the products you should know, otherwise you cannot use this method. And market price of joint products may vary frequently, but sales value at split off method uses a single set of selling price. So to determine the ratio of allocation, we are using one selling price, say $10. But maybe after 1 month, after 2 months, after 6 months, the sales value may change. But we are not, adjusting the allocation ratio based on the value changed. Okay, so that is what the another limitation. Now the third method is estimated net realizable value method, or we call it as NRV method, estimated net realizable value. So what is estimated net realizable value? This is what we have to discuss first. Often products are processed further beyond the split off point to make them marketable and or increase their value. So you are not planning to sell some of the products at split off point. Why? You can process further, you can do some modifications, some changes, then you can sell it at a higher price. So that will increase your profit. So some products you will process further, then sell it off. But maybe some products you will not process further, you will sell it at split off point. So this method can be used if one or more of the joint products must be processed. That means they don't have a sales value at split off point. They must be processed beyond the split off point in order to be sold. So you cannot sell this product at split off point. You have to further process, then you have to sell it off. Okay, now what is NRV in this case? The estimated NRV method allocates joint cost to joint products on basis of the related estimated NRV. What is NRV? NRV is the expected sales value in the ordinary course of business, or we can say this is the final sales value. Okay, after further processing, for what price you are selling it, that is what actually expected final sales value is. From that you will minus the separable cost. You will reduce the separable cost. Example, here we can say we have a product here, A and B, and B processed further, I spent $10 and I sold this for $35. I can sell it for $35. So what is NRV is final price minus further processing cost. So in this case it is $25. Okay, so indirectly we are finding out the cost at split off point, sorry, the value at split off point. So 25 is the NRV in this case, final price minus your separable cost. Again, we have the example here. An oil refinery produces gasoline and diesel at joint products. As joint products. And after split off point, gasoline requires additional processing, which cost 20 per gallon, while diesel requires 15 per gallon. So one product need to be processed further and you have to spend $20, and diesel you have to process further, for that you have to spend $15. And gasoline, it is selling for $50 finally, and diesel is sold for $40 finally. So this is the final selling price of gasoline, and this is the separable cost. This is the final this is the final selling price of gasoline, and this is the separable cost. This is for diesel, and this is the cost for diesel, further processing cost for diesel, and you have $10,000 of joint cost. So how you are going to allocate this joint cost based on NRV? So you have a total cost of 10,000. Now you will see here, gasoline sold for $50,000. We can say 1,000 gallon multiplied by 50. And diesel sold for $40,000, which is 1,000 gallon again multiplied with 40. So this is their final sales value. And we know that we spent $20,000 for processing, further processing cost at a rate of $20 per gallon. And this is for diesel. Again, for 1,000 gallons, you spend $15,000 at a rate of 15 per gallon. So now you have your final selling price, which is 50,000, and processing cost is 20,000. So if you minus 20,000 from 50,000, you will get NRV of 30. And here, if you minus 15 from this 40, you will get an NRV of 25. So total is going to be 30 plus 25, it is going to be 55,000. Now you will calculate the proportion. 30 out of this 55,000 is 54.55, and 25 out of this 55,000 is 45.45. So this is the proportion in which you have to allocate the $10,000 what we discussed, and the joint cost allocated will be in this way: 10,000 multiplied with 54.55 and 10,000 multiplied with 45.45. Okay, this is how we will do cost allocation based on NRV. So net realizable value method is generally used in preference to sales value at split off method only when selling prices for one or more products at split off do not exist. So you will use this method when one of the product or any of the product doesn't have a value at split off point. Okay, in another case, you can use if sales value of split off is not available for both or all of the joint products, it is acceptable to use in the same allocation net realizable value of the product that must be processed further in order to be sellable, while using sales value at split off for another product that can be sold at the split off point. So now you have two products. Okay, one need to be processed further, one can be sold at this point. So what you can do is, for this product you can use sales value at split off, and for this product you will calculate NRV, and based on this you can find out a proportion of allocation of joint cost. So that is allowed. So this is benefits and limitation. Net realizable value method can be used even when selling prices of one or more products at the split off do not exist, and this method is a bit complex. That is the limitation. It requires information on the specific sequence of further processing. You need more information, right? How the further processing is needed, what is the sequence of further processing, all those information needed. And selling prices of joint products may vary. This is same as sales value at split off point method. The selling prices of the final product may change during the year, but we are just considering a selling price that when we are making this allocation ratio. Okay, so that's it, the three methods. Now we have one more method, and that we will do in the next presentation or next video. And thanks a lot for watching, and thanks a lot for being with me.